Dear students, we are starting with the area Introduction to Financial Management. Financial Management is a paper with around 60 or 70 percentage problems and 30 to 40 percentage theories according to the different syllabus. When we hear the term financial management, we have to remember the word Ezra Solomon. Ezra Solomon is the father of financial management. Before proceeding to financial management, we will discuss what is different types of finance. Finance can be mainly categorized into two: public finance and private finance. Public finance involves the financial management of the institutions, just like government institutions, or finance of state government, local bodies like panchayat, municipality, etc., central government, etc. So public finance is the finance of government institutions, state government, local bodies, central government, etc. And the second category is private finance. Actually, it is as the name indicates, it is the finance which is related to persons, personal finance, non-profit entity finance, that is non-profit organization finance, business finance, etc. And business finance may be different kinds of private business enterprises, that is business finance may be sole proprietorship business finance, partnership firms finance, corporate finance, etc. There are different approaches to finance. The approaches are traditional approach and modern approach. The first approach developed is traditional approach. It was the approach that were in existence in 1920s to 30s. As per this approach, finance involves performance of only one activity, that is only raising of funds. We know financial manager has to do a lot of functions, but as per traditional approach, the main concern, the main task of a financial manager is collection of capital from the public, that is raising of fund required for the effective operation of the business. And the second approach, as we have mentioned, is modern approach to finance. As per modern approach, finance includes a lot of functions to be performed, that is raising of funds and effective utilization of funds. Mainly we can classify the functions into two: raising of funds and effective utilization. Actually, it includes a lot of activities to be performed by the financial manager. The activities to be performed are estimating capital requirements. What is the total amount of capital required by the firm is to be estimated as per modern approach. Then capital structure decision. The financial manager has to decide what is the proportion between debt capital and equity capital, capital structure decision. Then sources. There are different sources for collecting capital. It may be internal source or external source, debt capital or equity firm, equity share, preference share, debenture, bond, etc. The financial manager has to decide between different sources. Then investment decision. What are the investment avenues in which the amount of capital collected is to be invested? Whether it is to be invested in fixed assets, or in current assets, in working capital, or in projects, etc. Then next is cash management. Cash is an asset which is least productive. At the same time, liquidity problem will create a lot of risk among the companies. So adequate cash is to be maintained in every business. So the functions of modern approach includes cash management also. Then controlling surplus, that is whether the surplus or profit made by the company is to be retained in the business as a reserve, or whether it is to be given as dividend to the shareholders, etc. Okay, anyway, there are two approaches to finance, that is traditional approach and modern approach. Modern approach is the approach after the traditional approach. Traditional approach involves performing only one activity, that is raising of fund required, but as per modern approach it includes raising of funds and effective utilization of funds. Then let us go through some of the meaning of the term financial management. Financial management is simply, it means obtaining and utilization of funds necessary for the efficient operations. Obtaining funds and effective utilization. Another meaning is that it is a management activity concerned with planning and controlling of firms' financial resources. It is simply a management activity which is concerned with the planning and controlling of a firm's financial resources. These functions are to be performed by the person called financial manager. In US, these functions are, the financial manager's functions are performed by two persons, that is treasurer and controller. That is, the person who is entrusted with the task of raising of capital, collection of fund, is termed as treasurer, and the person who is entrusted with the task of utilization, investment, etc. are termed as controller. The next is scope or contents of financial management. It includes, first one, estimating financial requirements. What is the total amount of capital required by a firm is to be decided in advance, and which is the task of a financial manager. Second one is deciding the capital structure. As we have mentioned, the financial management has to decide between debt capital and equity capital. What is the proportion of debt capital? What is the proportion of equity capital, which is to be decided by financial management. The next one is selecting different sources. As you know, we have different sources of collecting capital. It may be from issue of equity share, preference share, debenture, bond, etc. It may be internal source or external source. It may be equity capital or debt capital. The financial management has to decide which source or which combination of sources are to be selected. The next is select the pattern of investment. In which asset the amount is to be invested, what percentage is to be invested in long-term assets, and what percentage is to be invested in short-term assets. The next, working capital management, that is liquidity decision. So working capital management involves deciding the quantity of fund to be kept in liquid form, what amount is to be kept as cash, what percentage of amount is to be kept in materials, or how to manage our account receivables. All these are coming under working capital management. Next is financial control. Financial management has to control the fund of the firm. Then proper utilization of surplus, that is dividend decision. If we have made a profit or surplus, we have to decide whether to allocate the profit for reserve purpose, or whether to keep it as retained earnings, or whether it is to be given as dividend to the shareholders. All these are to be decided by the financial management. Okay, thank you very much.